Okay, so going into this Bank of Canada meeting. Previous meeting, policy, unchanged, 1%. In bold, there's still slack in the labour market. There is caution on future adjustments to rates, but also an agreement that less stimulus is required. Now, in terms of expectations, reasonably limited. Unchanged is the main expectation for rates. However, there is a chance of a rate hike, and this is due to the unemployment change a few days prior being the lowest since 2008. Also, the past 3 days have seen 20% pricing in of a rate hike. This is what's pushed the CAD up, as you can see from the chart previously, and what has held the CAD higher. Also, there is possibility of dropping the word caution or cautious from their language regarding rates. Statement wise, that's what you're looking for. Any references to labour market slack, any upgrade to caution on rate changes, and any comments on changes to stimulus. So they're your three areas: labour market, rates, and stimulus. Now, in terms of levels, we're looking upside, not got a great deal to the upside, 79.02, then the most recent high and a high for quite some time, 79.23s. To the downside, we do have some structure in terms of that head and shoulders pattern. And the neckline will be your first area to look for, followed by the most recent low, 78.73, and then those three low volume areas that you can see lower down. So that's giving you your idea of where you want to be focusing. Now it's down to trades. First up, of course, if they hike rates. This is going to be a buy the CAD. This is going to be a buy looking to move through the most recent high above 79.23, distinctly hawkish outcome. Next up, they could maintain rates and also maintain an unchanged statement. If they do this, this is likely to cause a very strong sell in the CAD. The reason for this is that they're not willing to maintain rates. They're not willing to change rates based on the most recent jobs data. They're also not acknowledging that with the statement either. So that's where you could get a sell and hold trade. Very, very dovish situation from the Bank of Canada. Third, a slightly muted version of that trade, and this is where interpretation comes in. They can maintain rates and then also say there's less slack in the labour market and a little bit less caution needed. This then gives a sense of a bit of hawkishness from the Bank of Canada. Still slightly dovish in the fact they've maintained rates, but they are acknowledging there's less slack. They are acknowledging the change in unemployment. For this, you're likely to see a breakdown, but then potentially not that continuation, or certainly a bit of a slower continuation if we are going to see it. And finally, the slightly more hawkish side of it, maintain rates and reference that labour market slack has virtually gone and that there needs to be a removal of stimulus. So acknowledging forward that things are going to change rather quickly. What you're likely to see is a bit of a dip because of the maintaining of rates, and then that likely to get brought back up. So this potentially could be your fade trade for trade number 4. Fade or reversal trade you'll be looking for there. So be very aware of how they change the wording, particularly in relation to labour and also stimulus and rates. So good luck with the drill. There'll be questions to follow.
Welcome to the Bank of Canada.
the euro took
We're going to have a look here at a bank that's come into much more focus recently at Axia. This is a bank that has started to change its rhetoric throughout the year, so we'll have a look a little bit like the Bank of England, how they've shifted language throughout the year, and also has actually now begun on a path of raising rates. So Bank of Canada, because of the fact that they release their interest rate decisions in the middle of the European day, has certainly become another bank that has created a lot of focus and also creates a lot of opportunity for trades, particularly if you have your process and your template for how to trade central banks. So let's go and have a look at Bank of Canada and see what nuances and what little bits that you need to understand about the Bank of Canada before trying to trade it.
So after that initial trade, your opportunities.
Now, unlike many other central banks, the Bank of Canada is still owned by the federal government. It was also quite recently created in 1934. However, much like other central banks, it is independent, and they go to great lengths to try and point this out. It is externally audited, expenses don't go to the Treasury like government expenses, so they definitely try and separate the fact that whilst it is owned by the government, it does have no relation to political process and separates that ability to spend money with the ability to create money. Now, in terms of the makeup, you have a deputy and a governor of the Bank of Canada, and these are both appointed by independent directors of the Bank of Canada. However, the board of directors of the Bank of Canada is appointed by the Minister for Finance, and also the Deputy Finance Minister sits on the board of the Bank of Canada. However, does not have a vote in monetary policy decisions. So whilst he is there, a bit like the Bank of England, to give guidance from the government, he doesn't actually have a vote. Interestingly, the Bank of Canada's makeup is reasonably similar to the Bank of England, and the current Bank of England chief, Mark Carney, was previously the head of the Bank of Canada. Now, their mandate is to preserve the value of money by keeping inflation low, stable and predictable. And this is defined by inflation control target. You will hear a bit more on control targets from the Bank of Canada as well in a moment. Inflation control target 2%, and that's the midpoint of a range of 1 to 3%. So again, like the Bank of England, it's a symmetrical target. It's as bad to be above as it is to be below. So 2% is the aim for inflation at the Bank of Canada, and it is very much focused on inflation.
First spike low is right onto the top of the block.
So let's go and meet the members. Bank of Canada's governing council only has 6 members. There are other elements to the Bank of Canada that contribute to monetary policy decisions. However, the decision is taken purely by the governing council. Governing Council consists of just 6 members, but within the Bank of Canada as a whole, there's a Monetary Policy Review Committee and also 4 economics departments. As I say, the final decision comes down to the Governing Council, and it's a consensus decision. So again, this is not a voted decision necessarily, it's a decision whereby consensus is formed, and ultimately the Governor, Stephen Poloz, has the final say on the decision. Him and Caroline Wilkins are the 2 members that you particularly want to be looking out for in terms of any speeches, any communication. Other members are a little bit less likely to actually comment publicly and guide policy outside of a meeting. So beyond Timothy Lane, who you do very rarely hear from, it's all down to Poloz and Wilkins, who give the majority of Bank of Canada guidance going forward, and also any kind of change in rhetoric. In terms of when they release decisions, these come at 2 in the afternoon UK time. So let's go and have a look at how those meetings pan out, the setup before those meetings, and then also what you get in those meetings.
Very, very quick move, and all of that came about as it broke out.
So, coming into the meetings, Bank of Canada actually goes through quite a long process to get to its final decision that was released to the market. This all starts off with staff projections. So this starts off by using two of those economic committees to actually provide projections going forward. And this comes 2.5 weeks before the decision. There is then, after that, the major briefing. This is where they take into account surveys, where they take into account economic developments, how markets are reacting, how markets are moving. This comes 1.5 weeks before. So this is more a case of the economics departments discussing these ideas, staff coming up with projections and potential policy recommendations. You then, a week before the decision, get the final policy recommendations. This comes 1 week before. After that, you then, the day before the decision, get the deliberation and decision. So this is where the governors will take all of the information, take those recommendations from the various staff and economic departments, come to a final decision. The staff will give them their recommendations. They come to a final decision the day before, and then decide how they will draft it, how they will devise the wording. And again, much like any other central bank, the wording is extremely important. So they will draft all of this the day before, and then finally the publication comes on the Wednesday, and this comes at 3 p.m. UK time. In terms of meetings, very similar structure to many other central banks. There are 8 meetings a year, 4 of which have a monetary policy report, in which it includes staff projections and also a Q&A session with Governor Polis. In terms of a blackout period, and as I'm sure we've spoken about before, the blackout period is when you will not hear from any central bank member, and that comes from a week before the decision, so the Wednesday before and at the time of the final policy recommendations meeting. So that serves to not allow these final recommendations to come out to the market, and then total blackout of information until then.
Now, the Bank of Canada has a quite limited toolkit compared to other central banks, or at least a limited toolkit in the sense that it has not used a great deal of it. So the main focus for the Bank of Canada is still pretty much entirely interest rates. What you get from the Bank of Canada in terms of interest rates is an announcement of an overnight target rate. Now, this target rate forms the middle of a band, as with, say, the ECB, for example. So at the top of this band, you will have the bank rate. This is the rate that banks can borrow directly from the central bank. At the lower side of the band, you get the deposit rate. This is what you get paid on deposits put at the Bank of Canada. So that's how it works. That's really the only rate that you will see. It's the only rate that will get released, and pretty much the Bank of Canada's only tool. Now, the way they manage the liquidity in the system, i.e. to keep the rate at the middle of that band, is through the LVTS, which we'll have a look at in a moment. That's the Large Value Transfer System, and it's where the Bank of Canada conducts its OMOs, allowing liquidity to be pushed in or pulled out of the system. Now, beyond that, the Bank of Canada has no other tools, or certainly no other tools in use. When it comes to QE or other extraordinary measures that other central banks have very much made use of, the Bank of Canada has not done so. However, what they have got is a framework for unconventional measures. So what this serves to do is provide confidence to the market that the Bank of Canada will step in if need be. Now, the result of this is that Bank of Canada's bonds still get bought, perhaps in line with other central banks anyway. Think about the idea that if the ECB is buying German bonds, if the FOMC is buying treasuries, then the Bank of Canada's bonds are going to get dragged up in line with these anyway. What the framework serves to do is, as I say, it provides that confidence, and so that buying of Canadian bonds is acceptable risk because of the fact that the Bank of Canada has said that they will back up the bond market if need be. The result is Bank of Canada hasn't actually had to do that, have not had to expand their balance sheet, but this framework for unconventional measures does still remain. So that's the way they've managed monetary policy. That is their toolkit. Seems limited, but by implication it is not. Okay, let's go and have a look at the LVTS and see how that exactly works.
And it's then the new entrants that get squeezed.
All banking transactions in Canada go through the LVTS, and specifically the settlement account. The idea here is that throughout the day, transactions between banks happen and go through this account. Come the end of the day, banks cannot hold deficits or excesses in this account. The settlement account must be at zero, so there needs to be no settlement balance come the end of the day. So what happens if at the end of the day you have excess cash in that settlement account? Then this cash gets deposited at the Bank of Canada at 25 basis points below the overnight target range. Alternatively, if you're in a deficit, then you will transact via a repo, i.e. give up collateral in order to take back money, which would then cancel your balance in that settlement account. So that's how it would work come the end of the day. The idea here then is that throughout the day, banks will transact with each other in order to not leave that balance at the end of the day that will then either earn less than it would in any other transaction, or you'd be paying higher interest than you might in any other transaction. So throughout the day, if say you have excess cash within the settlement account, what you would do is then go out and lend that money to other banks in need of the cash. Therefore, you're going to get a better rate of interest than the perhaps slightly punitive 25 basis points below the overnight target. Likewise, a bank needing to borrow money rather than going to the Bank of Canada and transacting via a repo with them, could transact via a repo with another bank at perhaps a slightly lower rate, much closer to that overnight target rate. So this serves to maintain that target rate. What the Bank of Canada will do is, in situations where there is less liquidity in the market or an excessive liquidity in the market, they will then conduct their open market operations to either withdraw or inject liquidity. So reasonably clean cut, the LVTS from the Bank of Canada, quite nice and easy to understand, hence why you get one rate when you get the Bank of Canada decision, and that is that overnight target rate. Okay, so let's move on and have a look at how rates have progressed over the recent years for the Bank of Canada. And what we've got on the graph here is a representation of Canada's interest rates, the fall from 2008 right up to present day's most recent beginnings of hikes. Now, what we've also got on the chart is the dollar-CAD foreign exchange rate in green, and then also oil prices in orange. And what you can see is the influence that oil prices have on Canadian interest rates. Because of the fact that oil is one of Canada's biggest exports and also employs a great deal of people in Canada, it does drive inflation and drives the economy quite heavily. And so perhaps more than any other country, or certainly any other G7 country really, they are so much more influenced by one commodity price. And you can see that the Bank of Canada has actually fluctuated interest rates a little bit more than many other central banks, less so much influenced by the crisis and more influenced by oil prices. So we saw this in 2010 as oil started bouncing up from the low mid-30s, getting back up towards the hundreds. Canadian interest rates started picking up. This in spite of the fact that the Canadian dollar was strengthening, which would usually dampen inflation. Nonetheless, oil prices continued to rise. The interest rates were then risen in line. However, Canadian dollar strength remained. This then turned to weakness, but at the same time, that weakness in the Canadian dollar also ran into significant weakness in oil prices. This drop in oil prices again reduced inflation, and so this then led to cuts in the Canadian interest rates. Not entirely, limited to oil prices. You can't necessarily say to yourself, well, oil prices are going higher, therefore Bank of Canada is going to raise rates. It's not that clear cut, but it is perhaps a larger factor than many other central banks would need to factor into their interest rate decisions. So we'll move on now. We'll go and have a look at how the Bank of Canada does communicate their decisions and what you want to be looking out for.
Vote in accordance to that as well. So we're getting a movement into
Bank of Canada is, as I've said already, not overly communicative. You don't get too much information in between meetings, and again, all your information comes on that screen dump on the meeting. So the structure of their communication is 3 o'clock screen dump, and this is also accompanied by a statement. Now the statement, if you go and read through them on their website, each statement differs. There's a lot less structure in the statements than you perhaps would get from other central banks. Key areas to be looking for are the bottom 2 paragraphs. One will talk about inflation, the next will talk about their decision on rates and their view as to why they've decided that. So for this reason, because they're not overly communicative, that 3 o'clock screen dump is very, very important, and this is where the majority of trade is focused. Beyond that, you then have a press conference on every quarterly, which is also where they will release forecasts going forward as well. There's also a Q&A in this press conference. Now, unlike the majority of other central banks as well, the Bank of Canada is not averse to changing policy when it is not a press conference decision. So whereas with perhaps the ECB and the Fed to a degree as well, the expectation of any policy change is not there unless you're on that quarterly press conference where there is a Q&A. Bank of Canada quite happy to change in between, hence again why that screen dumps part of their communication is so important. Now in terms of the forecast that you will get, again, these are released quarterly, and you get a very detailed forecast for the current year. So you'll get a quarterly view of inflation and also GDP, real GDP that is. Beyond that, you will then get a yearly view going out for the next 3 years. So a bit like the Fed will give you that yearly view, but the Bank of Canada does give you quite a lot of detail very near term. You do not get any minutes released with the Bank of Canada, and furthermore you do not get any forward guidance. Governor Paulos has been quite explicit on this as well. It's been very clear to say that they will not give forward guidance, and most recently actually noted that the market is adapting to the fact that the Bank of Canada does not give forward guidance. So it is very much interpretation of the statement. And as I say, all about that screen dump. We'll have a look at a few examples of screen dumps in a moment, and you can see how the market reacts, and that's where you do get an opportunity. So we'll go and have a look at that in 1 minute. So if your focus is going to be on the press release and the statement, what parts would you need to be focusing on? First up, data dependence. Bank of Canada has generally reiterated a point that they will remain data dependent and guided by incoming data. What this serves to do is allow you to look at recent data to give you an idea of how a market is perhaps pricing in the next rate hike. So say, for example, you get an exceptional number on an unemployment number for Canada, probably the most important number alongside CPI. Say you're starting getting outlier type numbers there, that's going to influence pricing going into any decision. And so therefore, the Bank of Canada's interest rate decision or policy decision should likely be influenced by the data that you've seen coming out. This is a little clue for the drill coming up, so take on board that information about data as that drill comes up. Next up, excess capacity and labour market slack. Similar to the Fed, the Bank of Canada does focus quite a bit on the Phillips curve. This is the relationship between unemployment and inflation. Now, the idea here, and this is how to interpret these comments, excess capacity and considerable or ongoing labour market slack effectively means that the economy can grow without having too much impact on inflation, because you get to a point where the economy can grow so far before we hit a point where that growth in the economy now can't happen without increasing inflation by pushing on wage demands, that way increasing inflation. So their view on whether there is excess capacity and whether there is labour market slack is very important. So greater amount of spare capacity, excess capacity, therefore means that inflation will not get to a point where inflation is pushed higher, i.e. rates will not need to raise if they have considerable slack, considerable excess capacity. It's when this diminishes that's very important. And so it's the severity of how they describe the change in excess capacity and labour market slack that becomes very important. This is usually very clearly and very consistently qualified as well. So a very, very key focal point on the Bank of Canada. Next up, they will give a reference to the global outlook. This is often a reason perhaps to not do something or perhaps to start doing something. So they will always give reference to global developments, be this NAFTA talks, be this oil prices. Developments globally, the Bank of Canada will give a clue on, and also state how much influence they perhaps may be taking from these. So this is a bit of an ad hoc one, a little bit confusing in terms of there's not a consistent way that they tag this and not a consistent way that they will talk about it. So very much an interpretation trade, this one. Finally, you will get a discussion of factors that are influencing inflation. Now this is very important in terms of how these factors are influencing inflation, what their likely impact is. So, for example, Bank of Canada may or may not use the phrase transitory, and they have done this in the past. If they view inflation being impacted by food prices, by commodity prices, and suggest that this is transitory, then that increase or decrease in inflation, whichever one it is not likely to last, and so therefore can be looked through. For this reason, you do need to understand how Canadian inflation is moving into the figures, i.e. if inflation is rising based on oil prices and they suggest these are going to be transitory, then what that's suggesting to you is that rates will not need to be hiked anytime soon. However, if inflation is falling going into it and they suggest that's transitory, equally they're suggesting that inflation really should be a fair bit higher, and for that reason you can then still start expecting rate hikes going forward. So let's go and have a look at how the Bank of Canada throughout 2017 tagged inflation, tagged some of those key areas, giving you a sense of what they were likely to do at the next meetings. So let's go and have a look at how those focal areas evolved throughout 2017. Great way to keep track of this. Keep yourself a table with those key areas that you're looking for some kind of change or information to be developed within. You keep track of that as time goes by. Works for all central banks. It's a great way of keeping track rather than having to go back, read through statements before every meeting. You don't want to be going back over the same work twice that you would have done at previous meetings. So go and have a look back at last year. April, there's no reference to data dependence. Regarding the outlook, there were significant uncertainties. Regarding that excess capacity and slack, output gap is to be closed in the future. So basically saying we don't need to do anything just yet, but we do feel that we're perhaps moving towards that. So giving a little bit of clue going forward, but it's hardly anything clean cut, and certainly opens up room that, you know, if that gap remains, they don't have to do anything. They're not painting themselves into a corner, which is what a central bank does not want to do.
Maintain your stock.
Regarding inflation, currently it is at target, and so this is why they're pointing out that that gap will be closed but has yet to be. It's currently at target due to transitory factors. Now these transitory factors we'll talk about in the May meeting as well. So at the moment they believe that the reason inflation is high is not going to last. Policy stays 0.5%. Come May, again, nothing on data. Uncertainties continue regarding the outlook. There's still ongoing excess capacity, so still no reason to be changing rates. And food prices are pushing lower, in line with their thoughts from April. So they felt that the food price drop was that transitory factor. So food prices were higher, creating that transitory inflation. And therefore, as that started to drop, inflation dissipated, no need to raise rates. Now, come July, things had started to change. Data had started to improve, inflation had started to pick up. Now, first up, on the data dependence, they suggest that the adjustment is guided by incoming data, so they raise rates 0.75%. Confidence has been bolstered in the outlook, slack has been absorbed. However, they still believe that there is some way to go on inflation, so the softness is temporary and it should reach 2% come mid-2018. So they're suggesting that they're on the way to hiking, that these hikes could keep coming, but it's more likely to be quite slow until they reach that 2% target come mid-2018. So, what happens after that? We get better data, and you've got the clue to be watching data from the previous month, that the adjustment was guided by data, so you should have been watching the data. That also provides you quite a few trading opportunities. But come September, their decision again has been guided by data. Regarding the outlook though, stronger than expected economy. Excess capacity does remain, but it was that bit on the outlook, that stronger than expected economy, that has warranted the increase in interest rates. Slight increase as expected in inflation, so nothing new there. However, that improvement in the outlook is what's warranted a removal of some stimulus. This is a signal by the Bank of Canada that they are now sort of definitely on the road to removing this stimulus, the stimulus from low rates, and this could well be ongoing. This is a big shock to the market. I will show you this on a chart in a moment. It was about 50-50 expected for a rate hike coming into the meeting. Data had improved, but perhaps not markedly enough to warrant another rate hike the meeting after the prior. But it was a surprise, and you got a very, very large move, and we'll have a look at that in a moment. Now, come October, we're now starting getting that settling down, and you often get this after a hike, that the sort of rhetoric, the language settles down a bit as the bank doesn't want to then sort of stoke the idea that there's going to be more and more rate hikes coming faster and faster and faster. So come October, once again, they'll be guided by incoming data. So, as I said before, this is now key for that drill that's coming up. Think about how the data's improved, and that will get explained before the drill coming up. However, there is now substantial uncertainty around NAFTA. This is the period where Donald Trump's starting to renegotiate NAFTA. A lot of uncertainty as to what exactly he's going to do there, and that could have damaging impact on the outlook globally and certainly for the Canadian economy. This excess capacity remains. More growth without inflation, and there's still slack. So they could still have more growth without that pushing inflation above target, and there is still slack in the economy. Labour market not yet a source of inflation. So again, pointing out that previous fact. And it's also been impacted by the higher price of the Canadian dollar. So that higher value of the dollar has been impacting inflation and reducing that down a little bit. So no change on rates in October. And they're also going to be cautious on any future adjustments. So this is certainly a step back from warranting removal of stimulus, and perhaps they felt that they slightly overstepped it there, and then they try and pull that back a little bit. Still less stimulus over time, however that caution was the key word there, that they're not necessarily going to start rushing into things, they're going to remain quite cautious going forward. So let's go and have a look at how they played out. We'll have a look at how the screen dump would have appeared, so how you can understand the news, the order that comes out in, and then also the market's reaction and why you got certain reactions to it. So let's move on to that and have a look at some of these. This is how July traded in the CAD. Now the most important thing to be looking at is the line that explains whether they've changed rates or not. In this one, it's the bottom line, so what happens is that will be the first thing to come out, and then that scrolls to the bottom as more news goes on top. So remember, always read from the bottom up. Now, Bank of Canada, in this instance, raises overnight rates to 0.75%. Recent data has bolstered confidence in the outlook for above potential growth. So that's your key line. That's what you're looking for, their view on how things are going, as well as whether they are changing rates. And that's what often creates a little, sometimes, move the wrong way before the initial first move. You can see on the chart that what you get is you get a jump up, reversal, and then go again. The reason for that is the second line. If you read the second line from the bottom, they'll be guided by incoming data, keeping in mind continued uncertainty in the financial system vulnerabilities. So you get a little bit of uncertain movement to start with before you then move on to the rest of the statement, which is definitely got more of a hawkish bias. Softness in inflation to be temporary, economic slack has been absorbed. So do be very aware that often on these decisions, because you get loads of information, you get a lot of interpretation from various different people, and you only get the move once you've got a general consensus on what exactly that means. And that's why you will often get these initial jump one way, which then reverses very quickly, only to then continue in that direction. Ultimately, there was a rate hike. This was reasonably well expected. So the hike wasn't the major surprise. It was that continued reference to inflation only being temporary, and the economic slack has been absorbed. A significant amount of economic slack had been absorbed as well. So that's what got that move going. And as with a lot of these decisions as well, you'll see this on the drill, that the first move is often very quick, followed by then a slower continuation of the move higher, as more and more people who can't get in on that first move then start to execute trades higher up. So this is either a hit and hold situation if you can get in early enough, or it's a passive continuation trade whereby you're looking for an entry to get in as you get a pullback before then holding on to that trade for that continuation. But the interpretation at the beginning is very important, and that's what prevents you getting caught up in that initial jump up and down, but also allows you to remain convicted if you have got in and the market then skips with you onside, offside. If you understand what you're going for, i.e. that the rest of the statement comes out very hawkish, you can then stay in that trade. Let's go and have a look at how this then further develops as we move into September and then October as well. In terms of giving you a clean-cut trade, September was ideal for the Bank of Canada. There was a 50-50 expectation of a rate hike. Rates were hiked the previous month, and so therefore there's less expectation that they're going to do 2 hikes over 2 meetings. However, data had improved. So that was creating this 50-50 view between one economist, but also in the pricing of a rate hike. Uncertainty, that is ideal. It's just what you want, because therefore it meant you had a very clean-cut binary trade. Rate rise, you were going to see the CAD get bought. Unchanged, you were going to see the CAD get sold as that pricing got taken out one way or another. Either it further priced in a hike, or it completely took away that price of a hike. So you had a nice clean-cut trade, and so for this meeting, the focus was entirely on the rate. Hence why you don't get a sort of spike either way as you get that interpretation trade. It's very much off the rate, market goes. In this instance, rates were increased to 1%. What then kept the move going as well, and what perhaps caused that final sort of flurry higher, was the fact that the rhetoric along with this was also reasonably strong. The stronger than expected economy warrants removal of some of the considerable stimulus. So it's suggesting that there's going to be further removal of stimulus. Decisions are not predetermined and they will be guided by data. Now, what this is saying to you is that after they've done 2 in a row, and effectively this hike was very much guided by data, if data continued improving, it would not be unreasonable to think they could hike the following month as well. So that's now starting to quicken the pace of these hikes. So another very hawkish sign, an extra reason why that CAD gets bought and bought and bought.
This is the level of it.
They do go on, however, to say that some excess capacity remains in the labour market, and so this is taking it back a little bit. Yeah, they're sort of very hawkish, but then give a slight dovish element to it. Now, in terms of the way this trades, very, very fast move. This is 200 ticks. The move on the last decision, around about 50 ticks and a bit of continuation, taking it to around about a total of 70. Here, however, 1 minute move, 200 ticks. That does seem a little bit excessive, and hence why you get this very large pullback. Now, what you have to be thinking about on these type of moves is, one, how far it can come back, but being patient in your chance to buy it. It'll be very, very easy after it's shot up that the first flick back, you then start trying to buy it. However, if you have a look, we actually get a pullback of a full 80 ticks on this. We drop all the way back down towards 81.80. That's where the low volume comes in. If you have a look at where the volume profile is on that chart, you see that there's a distinct lack of volume below 81.80. So this provides you a bit of support, gives you a place to get in. We then get a rotation back up, but only to the wick, and that was the point where you got that final exhaustion. That bit of the move would have been extremely fast. So if you're in on this, that is an ideal place to exit. That's the exhaustion trade. And so what happens is, as the market trades higher, you get this final flurry of stops, but people rush in to buy. That's a very good indication that you should perhaps be considering getting out of that trade. So as you see it, you have that in your plan, you're ready for that. As soon as you get that exhaustion up, out you come. And then you get the pullback of around 80 ticks and then consolidate. So on these pullbacks, as we talked about in the preparation, be patient with them. After that first 1 minute move, it slows down. It then offers you a chance to start to think about what's going on. Just because it's moved very quickly initially doesn't mean you need to start making decisions on the spur of the moment very, very quickly and trying to jump in and jump out of trades. Wait, let the market establish an area that it wants to trade within, and then you can trade from there. And so it was 2 minutes it took before it actually gave you the opportunity to buy around those 81.80s before then grinding back up. And that's the other thing to remember.
So what we've now got is a range.
Once that initial move's happened, particularly when it is real game-changing information, rate hike when it was not exactly expected is a big, big deal. So as it comes back, you're then thinking, right, this could be a much, much slower move higher to complete that little bit of a move, and then consolidation that we see for the rest of the day. And that consolidation comes because of the fact that we've moved so far, you're less likely to get that continuation. Also, the end of that move is very much done on an exhaustion. Okay, so that's how we've traded July and September. We'll now go and have a look at October, whereby you can actually see the interpretation trade in it, and we'll talk about that in a moment.
And we're starting now to actually just have a little bit of a tip through.
The October meeting was a great example of people getting their interpretation wrong, and this giving you a trade opportunity. That all-important first line comes out, no change on rates. Okay, that was what was expected. However, it's what comes next that's important. It says that while less monetary stimulus is likely to be required over time, the bank will be cautious about making future adjustments. Now, a lot of people will have gone off that first phrase, less monetary stimulus likely required over time. So that less monetary stimulus over time deemed hawkish, more rate hikes coming, and so you get that very quick buy up, and that's that little wick that you can see on the chart. 15 to 20 tick up move. However, if you continue to then read on, the bank will be cautious in making future adjustments. You've got a clue to this because it says while less monetary stimulus, and so that's almost saying but something else, and that something else is that they will be cautious in making future adjustments. This then turns the market round, and your trade opportunity here is knowing that people will have bought that first bit of the comment. That's what skips the market up. Now, as it comes back through the opening price, that's where any of those longs in that spike then start thinking, right, we're wrong now. They'll start rushing for the exits. A short through that area will bring in new selling, and that's what turns the market back down the other way. So often these interpretation trades give you that opportunity whereby the market goes the wrong way initially, based on the very first comment, only to then get turned over as the rest of the commentary and understanding and interpretation comes through. It becomes a reasonably dovish statement after that. Still slack in the labour market. More economic growth than projected without inflation rising materially above target. So again, that's showing that there's more slack in the economy. Substantial uncertainty about NAFTA. Inflation is picked up, but this is due to, well, the inflation is picked up, but it's going to be dampened by the Canadian dollar. So actually, it's going to rise to the 2% target later than was expected in July. Yet they've already raised rates once. So this is very much saying that there's no rate hikes coming, perhaps for quite some time, whereas it was expected that rate hikes would certainly be coming a little bit earlier. So a lot getting priced out here. In terms of the trade, like I say, your initial trade was on that catching of the people who interpreted the information wrong. You then get the move lower and then a continuation opportunity. The second minute candle starts out right on that little low volume area. You can see that the volume builds up to a point around about 79.80, and that's where that next candle comes in. Doesn't make its way into that low volume area, the lowest volume that you can see in the middle of that range, and then starts to come off once again. So that was your opportunity. Again, you didn't have to be super fast on it. This is a whole minute later that you can still get in, and you're still then looking for that continuation towards new lows. We make a new low and then put in a small rejection candle on the 1 minute, which can allow you out of the trade, unless of course you had a level that you were targeting lower down. But this very key and something to watch out for on all central banks, that misinterpretation whereby the market goes off a few words rather than the whole sentence. That way you get an opportunity to go against it, and it's the move back through the open of that candle, back through where that first bit of move started from, that then really kicks on the next bit of move. And that can also extend the range that little bit more because of the fact you've got positioning trapped. This dropped around about 100 ticks on those slack, on those inflation comments. We then consolidate once again towards the low. So after you've got that first move, keep thinking about how you can then take on more passive, slower trades. If you have a look, that the highest spike in the consolidation as well coincides with the low of that first minute candle, and that is also a key area to be watching for. The low or high of that first candle, that real strong initiative, highest volume candle, often creates a reaction when you get back to it. So watch out for those. Keep a note of that mentally, or write it down very quickly after the figure. That way you've got reference points to be looking at as the market comes back. And you're taking that trade on very much as a scalp trade over this. Yeah, we've already established a sort of little bit of range at the low. So you're taking it as a scalp and just running it back into that range. So, time now to move on to a drill. You've seen what's happened in July, in October, or in September prior to the October as well. We'll now go on and give you the drill in December. So we'll explain the drill in a moment. Questions will be coming up. First up, I'll run you through a chart of how the market was looking coming into that December meeting. The key thing in this drill is your understanding of market structure going into a central bank event. What we got prior to the Bank of Canada rate decision was a very strong move higher on the Canadian employment numbers. This then started to price in the possibility of another rate hike, remembering that Bank of Canada is data dependent. So what we've had is around about 150 tick move higher that then consolidates, creating on an hourly chart a head and shoulders pattern. So what this does for you is it allows you to start thinking of trades in terms of what is going to have the greater impact. So what trade are you more inclined to take on, or would be more willing to try and take a trade on? And this, for me, you'd be looking at this and thinking, move to the downside is perhaps a better trade. Reason for this is that you've already had 150 ticks move to the upside. If you get something hawkish or a rate hike, how much further can this go? We looked at previous examples, and you got around about a 200 tick move on the hike. With this already beginning to be priced in, how much further are we likely to go on this is the question you've got to ask yourself. However, with this pricing, if you get a move to the downside, there's a lot of positioning that is then easier to come out of the market, causing a much quicker and perhaps more sustained move to the downside. So this structuring idea and this thinking about how the market is set up provides you an opportunity to start categorizing your trades in terms of trades that you would prefer to be taking on versus trades that you do not want to take on. For example, if we had a hike, it would be quite reasonable to think that that first move may well, it's going to be quite substantial, but is a move that's a little bit more fadeable than perhaps no change and slightly more dovish rhetoric. That is a move that is then likely to be less favourable, or less favourable to people trying to hold on to positions, and they're going to start coming out of those positions quicker. You've got areas as well here, and so in your planning you can start thinking about, well, how can you get into a trade here? If you're looking to the downside, you've got that head and shoulders neckline coming in at 78.78, as well as the level at 78.73. So that's going to be your area to be looking for. If you can get in a trade around there for that breakdown, you're then in a nice position to be playing not only fundamental news, but a technical pattern based on the structure of the market. And that's the important thing to be remembering here. To the upside, if we start breaking above 79.02, it then sets you up for a move towards the highs up at 23s, and that you would expect would be where we'd be heading towards on any kind of rate hike. So that's the way the chart's set up. In terms of areas to be targeting to the downside, if we do get that breakdown, the way I'd always look at it is when you get a strong move higher, this leaves points where there's limited trade. So these low volume nodes, areas where the market is then likely to try and find some sort of support. Will people then come in and buy there? That low volume area is created by people buying very quickly through an area, and so the implication is there are buyers in that area when we come back. So these areas come in at 78.50, 25, and then lower down at 77.90. So they're going to be your target areas to the downside. As I say, I've already mentioned those areas to the upside. So move on to that drill, and then there'll be questions coming up as well.
Once the press conference then begins, and you'll see if you look at the annotations where trades are then executed.
Now this drill is an observational drill. The reason that we've done this is to allow you to actually slow your thinking down a little bit. When you're not actually trading it via a replay or sort of, replicating that real life situation, you realise how long it does take sometimes to actually come back to areas to give you a trade, or how long it actually takes to break a level. This way it allows you to step back a little bit, remember that structure, and going into this drill, think about that structure. We spoke about it on the charts. Think about what implications there are there and how this can then start developing some trades, where it can give you opportunities to get in and how you would execute those trades. So there's some key considerations. So drill is have a look at the replay of the December meeting. There will be questions not only on how the market traded, but also the information that you get. So watch the video, the prep video, then take on the video of that December decision. Questions will then follow up.
Quick move down towards 69, so your main target should be 69. The speed of the move down then is your indication to get out. We see much higher volume, delta drops on that move down. That's the flush, that's the stops, that's what you're looking for, and that's the breakdown of that structural completion. As all of those stops get pushed out, that provides you the move and gives you that exit down at 69s. But all of that, it was all about recognizing the move into 95s. To start with, when you drop below 17s, you got the bounce away, and then the second time round, anyone who bought it thinking that they got away with it buying those 95s are just adding to the shorts if you get inside that block. So that first bounce from 95 actually helps you out on the wider trade. It just means that anyone selling below 17s actually gets quite a hard time and can be sitting in a relatively nervous trade waiting for then the larger move to actually play out. But that was the main trade, and it was all about understanding that move into that block that provided you with that opportunity, and that's your structural completion trade. So make sure you're thinking about those situations when you go into any of these central banks, because they can provide often a bigger trade. In this event, we didn't get any new information. We didn't get anything new in the press conference either. The tone didn't really suggest anything, and that's then where you don't just sort of step back and say, oh, okay, we've not got anything from this central bank, there's no opportunities. This is where you can start then leaning on your structure and leaning on other trades that may well come to play, because there is so much more volume. If you look at the volume on the hourly chart, look at those volume histograms, much higher than anything on the prior 4 days. So that extra volume, those extra participants is what creates the movement, and that's what you're looking for these structural completion trades. We'll go on now and we'll have a look further at more technical trades, beginning with a position squeeze. Okay guys, so on to the second technical play that you get over a central bank, and this is a position squeeze trade. Now, the whole premise of this move is that the market is pre-positioned, either pre-positioned for a technical play or pre-positioned in the expectation of the central bank doing something, of acting in a certain way. So you've got two different types of squeeze here. First up, you have technical plays. So people have got themselves into a position, perhaps, for example, trying to play the breakout of a wedge. Now, the idea here is that you've now got people, say, short at the bottom of a wedge, looking for that move to go down. What that then means, and this is similar to the play that you got in the euro that we discussed over the ECB. What that then means is you've got a lot of people who are in a position with quite tight stops, essentially not wanting to take too much risk on this trade. What can then happen is you get a stop out of those positions, there's your squeeze, and then the move continues in the way that it was going to go. So that's your first way of looking at it. The flip side of that is, rather than people having positions for a technical play, a sort of technical breakout type move, is more where you've got a directional move into the event, into the central bank decision. And then what happens is it's not so much a squeeze of the positions going into it. So say, for example, you get a move up on a play for a certain central bank decision. What that's showing you is that people are positioned now long going into this. What would you do if you were long going into a decision? Well, on that decision, if you get the decision that you're expecting, there's your chance to get out of the trade. So you're using the liquidity of the new buyers that come in on the release of that decision to get yourself out. What this then serves to do is create a spike in the direction of the original move, and it's the new positions that enter on the perceived new information from the central bank, which ultimately it is confirmation of new information, confirmation of that decision, those new positions that jump in then get squeezed in the opposite direction as the traders who already have their positions use those new entrants as liquidity to exit their existing positions, and it's then the new entrants that get squeezed in the opposite direction. So what we'll have a look at is I've got two different examples here, both over the Bank of England, and one example of positioning going into it, whereby that positioning is then the move plays into that positioning's trade, and you then get the squeeze in the opposite direction. And then the alternative, where you have a technical setup positioning for that technical play that is then squeezed in the opposite direction before that move completes in the same way. Now, considerations for these type of trades. In your planning of any of this, or a trade like this, and you can plan for a trade like this, in your planning for it, what you need to be thinking about is, where are those positions going to exit? So the positioning of the market, what are those people going to do? So put yourself in their head. What would you do if you had that position? So where would those people get out? And also, in doing that, you're answering the question of where could that squeeze reach? So, for example, you may have short positioning and a level a fair bit higher up, commensurate with a standard sort of central bank type move. So if you're looking in the pound, for example, something between 60 and 100 ticks higher perhaps, you could be looking there and thinking, okay, well, maybe that's where the squeeze could go. The stops could get dragged out up to that point, and then we can turn around. Now, that's giving you a little bit of scope, a little bit of an idea of where you might want to try and execute a trade. The next step is, how do you execute that? And you've got one of two options here. First up, and this is more a case where you have a technical type positioning, is a fade. The idea of the fade is if you get a rush against that technical positioning, that's going to jump to a certain point and give you the opportunity to go straight against that move. There's your first trade then, and so that's a very quick, as we've talked about before, quick jump up, sell into the move as it goes up. The important thing here is that you don't get anything from the central bank that is overtly out of line. So you don't really want a binary trade situation. If you have a very binary type trade situation, that could completely change the dynamic of the market. So that's your first opportunity. The alternative to this, and the perhaps slightly safer route, is to go for the reversal trade. So once the squeeze has happened, you're then using that information, that inability of the market to keep a move going in one direction, as your reason to play the reversal. You've got a couple of different options here. First idea is going to be a move back through the scene of the crime, so back through the point where the move began. And that's quite a common trade to see over a central bank, where people jump on the first piece of information, and then as more information comes out, the interpretation changes, and that takes the market back through the scene of the crime, back through the point where the initial move began. That's your first reversal idea. The alternative to that is waiting for an access point to develop. You're not going to know exactly where that point's going to be, and so pre-planning that isn't really something you can do. But what you can be thinking is that if you get that squeeze type move, there is going to become a point that allows you into that trade. I'll try and talk that one through when we go and have a look at the technical squeeze and reversal in the coming slides. So let's go and have a look at the first example of this, and this is a move over the Bank of England, where you have had the market position itself into the decision. So let's go and have a quick look at that. First up, we're going to have a look at a situation where the market has positioned itself into the event. So what you can see here in the pound is that we've had quite a rally going into the Bank of England decision. Past 3 days, and including the morning of the decision, the market has rallied. We've moved up from around about the 139.40s all the way up to around about 142.30, so around 300 ticks of upside activity. What this is suggesting to you is that people are playing for this move. They're getting themselves into long positions in the expectation that the Bank of England is going to suggest that potentially rates could still rise in May and give some kind of indication as to how that's going to happen, potentially vote in accordance to that as well. So we're getting a movement into this. The other thing to take from the technical player here is that going into it, looking at the profiles, and what you can see here, you can see the profile of the move itself, which is the profile furthest to the right. The profile to the left in the middle of the profile chart is an indication that the market is becoming stretched. We've seen a close that is a long, long way higher, the close indicated by the red asterisks. This is much higher than where value was the previous day, which is down at 141, 42, 44 area. So the market's now getting a little bit stretched. Think about what that means for those who are in positions. If you're long, and perhaps you've been long for a couple of days, yes, the market's becoming stretched, but ultimately you're still on side. You're playing for the Bank of England to give a more hawkish decision. Now, what are people going to do when that happens? What's going to happen is, as the move jumps, as people buy based on the hawkish decision from the Bank of England, those who are already long are going to use this as an opportunity to sell, to exit their positions. And this is where the squeeze comes. The squeeze comes on those who buy on the decision. They buy on the decision, create the spike up, and then they get squeezed in the opposite direction as the market starts to come back. So let's go and have a look at the expectation. Expectation is 9-0 for unchanged rates, but still potentially an indication that they could hike in May. So 9-0 for an unchanged of rates. We've got highs all accumulated around about the 142, 22s to 27s. So that's going to be your area that if you get any jump above there, you're expecting people to start taking profit. The result is that you get 7-2 vote for a hike. So 2 people voting for a hike. However, the interpretation side of this trade is that they add the information that data is broadly consistent with February. So whilst 2 people are voting for a hike, currently data hasn't changed, and so therefore there is no reason to believe that they are likely to hike rates anytime soon. It is just a couple of members. So what you can be thinking here is those who have played long into this are likely to get out. Those who have just bought it on the 7-2 are now in a sticky situation, and this dynamic can add to the selling, giving you a target initially of back down towards 142.04, the previous day's high, and then back onto the top of value, which comes in at 141.44 to 46, which is also a previous high from a few days prior. So you've got targets. The hard part of this trade then is how to enter the trade, and we'll go and have a look at this on a 1 minute in a moment to see where exactly you could have got into this trade and how you could have executed the trade, as well as what to expect when you get in, because that's the other really important part, and particularly important when you're debriefing these types of moves. How exactly does that move play out? What are you looking for when you enter that trade? That way you're managing your expectations going forward. If you expect a move to take half an hour to play out because it's a passive continuation on a reversal, then you're able to sit with it. But if you get into a move expecting an instant reaction and a very quick move that puts you on side, you're going to struggle to hold on when it takes its time to actually play that move out. So that's the important thing to take from this. We'll go now and have a look at it on a 1 minute, have a look at where those opportunities were and how you could have played this trade. Okay, so here is the reaction that we got. The first jump up, we moved from 142.10 up towards around 142.70. There's your spike up. That's the reaction to the 7-2. That takes you through the recent highs at 142, 22, 27 area. And that's where people are then rushing to buy. Those who are already long are going to use this as an opportunity to exit, to take their 300 plus tick winner. And that provides some selling pressure. The next element of selling pressure comes from that aforementioned piece that data is unchanged since February. So now you've seen the squeeze, you're starting to see the squeeze. People have entered and the market's starting to come back on them. Now what you've got to do is try and find your entry point. First opportunity here, and we tried to break this down into 3 opportunities. The first trade is a fade. As it jumps up, you can fade it on that very fast move. Now the difficulty with this is we don't have a great deal of reference point. There's no clear level that you can say that would be a good point to fade from. So that makes it quite a tricky trade. Your next step is then actually planning out an access point. How do you get into the next leg of the trade? Now what you can see is that the market falls back and starts to hold above the morning's highs. The morning's highs right around that level, 142.27. So we begin to hold that. And what you're looking for here is then a change in price action. You're looking for a little bit more pace to be coming into the market, more volume getting put through. And that gives you the opportunity then to play a breakout or a breakdown trade back through the morning's highs. And what you're looking for then is a relatively quick move down towards the previous day's high, which comes in at 142.04. This plays out rather swiftly and actually plays out in about 3 minutes. So there's your quick first move. But still, remember, we've now spiked to the upside. We've still got people who will be positioned thinking that you're going to get then a pullback and a progression further up. So we've still not seen all that positioning coming out. Remember, this is also a market that has traded up into this move. So you've got a lot of positioning long that are all going to have stops lower and lower down as the move starts to pull back. So your second trade then is to be looking for a passive entry. Previous highs, remember, were 142.22. So you get a pullback up there, and as long as we're not getting back above those previous highs, that's where you have an opportunity for a passive entry to sell as the market rises back up, with the intention then of running this right the way down towards the previous day's value area high and those previous highs at 141.46. That's your bigger target. Now the important thing to be thinking about here, or to be taken from this, is that this second wave trade is a trade that's going to take much longer to play out, and in fact takes around about 2 hours to actually achieve the move. The move's a full 80 ticks to the downside, but it takes 2 hours to do it. And this is something you need to have in your mind when you're taking these trades on. That yes, you can see the entry point, yes, you can see the target, but what often happens is then the middle part goes out of people's heads, and all they focus on is the idea that I'm in here and it's going to go here, and they view it as a straight line move. Now, it's a second wave trade. So this is going to have, the market's going to have slowed down. You can see that volume's fallen off by this point. So you're going to get a much steadier fall from here, a much steadier drift down that's going to take that little bit longer. Now, if you've planned for this and you're ready for it, then that makes an absolutely fine trade, because you're able to then hold on to it. And your particular point of confirmation is when it breaks the lows at 141.90s. They were the lows that we'd established on the back of the initial pullback before the bounce up to give you that passive entry. So once that breaks, then you're confident that the trade is on. That's where your confidence increases, and that's where you can say to yourself, this is going to work. Maintain your stop above the previous day's high, above 142.04, and then you can start targeting that larger move down. So that's how you'd be looking to try and play this. 2 opportunities predominantly: the breakout to the downside for that initial reversal trade, followed by then the passive entry for the much steadier continuation move. You can play this as a combination, that you get in on the first trade, cover some and then add in for the second, or this can be played as two distinctly separate trades. One, the first squeeze of those initial buyers that buy at above 22, and then secondly, as a passive move for this steady continuation to complete the move all the way down towards 140, 146. So two different ways of playing that same idea. It's all about recognizing that people will have given up on their long positions as you get the spike up, use that liquidity to get out, and it's the new buyers who enter at the top of a range that are the ones that get trapped and they get squeezed back the other way. We'll now go and have a look at a technical reversal or a technical squeeze of positions followed by the continuation. So both reversal type plays. We'll go and have a look at that. This provides a little bit more of a clear fade point, a clear sort of reference point where you could fade this, and you'll see the difference in the nature of the market going into the event. So we'll go and have a look at that. This time, the Bank of England once again, but in August in 2018, a few months after this decision had been made. Here we're going to look at a technical reversal. So a reversal of people who are positioned for a technical trade as opposed to positioned in the expectation of a certain event from the Bank of England. So in this situation, you can see the very clear difference. No trend move into this, no directional play into this. The market has been sitting for a couple of weeks between 131 and 132. It's also developed into a wedge, which we're beginning to get towards the end of. And this is where the technical play first comes in. From the morning's trade, and you can see the entirety of the move here, but the morning's trade gives an opportunity to play the break of the wedge, which also coincides with an inside day. The previous day was an inside day, so as that inside day breaks below 131.19 and breaks the wedge at the same price, you've then got an opportunity for a short. Excluding the Bank of England from this is a trade that you would be looking to take. Good technical setup, provides reasonably tight risk reward that you're playing a breakout below the inside day through the wedge and looking then for a move into the consolidation that you can see on the left hand side of the chart, and particularly down to where the majority of the volume is in the 130, 60 to 50 range. So that's going to be your main target on this. Now what's happened so far in the morning coming into this decision is there has been a move out of the wedge that has tested down to 130.90. This is where positions are getting accumulated. People are trying to play for this larger move, getting themselves short below the wedge in that range between 19s and 90s, looking for the continuation and potentially for the Bank of England decision to help with that continuation. Now put yourself in those people's shoes. If you were short on the break of the wedge, on the break of the inside day, where would your stop be? Well, for most of these people, or for many of them, their stops are going to be back inside the wedge, back inside the inside day. And this gives you the clue of a potential squeeze of positions. That anything that turns back up inside this wedge, all of those shorts who played for that continuation, that breakout below the wedge, below the inside day, are likely to come out. And remember, you get lower liquidity over these central bank decisions, so that's potentially going to create a larger move to the upside as well. The added benefit here from a technical point of view as well is that you've got a reference point for this squeeze. You're likely to get people wanting to sell the top of that wedge, wanting to sell that downtrend. So a move back up towards 131.73 could well be your opportunity to fade, to sell any fast spike up for the move lower, assuming that you don't get anything overtly hawkish, for example, a rate hike or a very, very strong vote for, not a very strong vote for a hike, a strong vote for a hike and an indication that we would get further hikes in the future. So, in terms of expectation, what we're looking for here is a 7-2 vote for a hike and the suggestion that you're going to get 3 hikes over the next 3 years. So we're expecting a rate hike, and we're expecting 3 hikes to be indicated over the next 3 years. Now, what you in fact get is you get a result of a 9-0. So no dissenters to this rate hike. Everyone votes for the hike. And this is what then squeezes those short positions out. The initial reaction is this is hawkish, squeezes the short positions out, gets to spike to the top of the range, and then reverses. Another interpretation element, much like the previous, is that they suggested that it would be 1.5 hikes over 3 years rather than 2, and that Brexit risks are still prevalent. And so therefore, the indication that hikes are going to be ongoing and perhaps more aggressive than people thought is no longer there. That's very important, and that's what turns the market back down. Once again, we'll go and have a look at this on a 1-minute chart in terms of picking out where you could enter these trades, where those opportunities were. What we'll then do is contrast this with how it actually trades on a ladder, because it's very easy to pick trades out from a chart. And this is where that debriefing element is so important. Looking back at how exactly it did trade, could you have got into any of these opportunities? So we'll have a look at it first from the point of view of where seemingly you could have entered trades. And then we'll go and have a look at it from a ladder point of view as to how exactly you may well have been able to execute those trades. So let's go and have a look at that short-term chart. Okay, so here what we've got is the 1-minute chart as well as the screen dump, the release of that information. And you see the 9-0 is the first thing to come out at the bottom. Remember, you read from the bottom upwards. And then you get a little bit higher up. The reference to the market rate path flatter than in May implies bank rate of 1.1 in 3 years' time. That doesn't suggest 3 hikes over 3 years, because we're already now at 0.75, so it suggests only 1.5 hikes. So that's where you get this fade opportunity from. Now, looking at a chart, your first thought is, well, you have the fade from the top of the range, up at those 73s. So that's your first trade. Jumps up on the 9-0, and there's your fade. What you then have to do, and we'll see this on a ladder, is the actual trade opportunity there comes more in this fast recognition of a range establishing between 131.50s to 20s. And we'll see that range then trade up and down, up and down. Next up, you're then looking for a breakout trade. And with a lot of these types of trades, it can take some time before you actually get the opportunity to take the trade on. And this is what I mean about trying to find your access point. It's not always going to be crystal clear where you can get into this trade. You can't plan beforehand where exactly you would want to get in. What you do know is there are some very key reference points. 131.10, for example, was the previous lows and the point where people were looking for this breakdown on that inside day and the wedge break. We'd also established lows at 90s for the day. So a break of 90s then accelerates this idea of falling. It also means that anyone who has bought it on the decision is definitely wrong. No one could have bought it on the decision and still been on side when you get through the low of the day. So what you're starting to look for then, and this comes into trade 2, the breakout element, is clues for this. And what you see is we have around about 45 minutes of sideways trade. But you get a very good clue that once we've established this range between 20s and 50s, is you then start to get quite this heavy sell-off. Comes a few minutes after the decision. Heavy selling back down once again towards 131.10. So we're seeing that the sellers are willing to take control here. Don't get any movement back up, and so the 131.10 then becomes your access point. We've tested it. By the time the breakout comes, that's been tested twice. You're looking then for your entry as it breaks through there. And as it breaks through, potentially a pullback and a stall there to give you a passive continuation trade. So that's your third opportunity that you play in the passive trade as you break 10 to get in, still with the intention this is going to fall through 90 and then continue down towards that 130, 60 to 50 range. In terms of your exit, what you're looking here for is any exhaustion into that zone. So rather than putting a definitive this is the level on it, use the price action to show you where that level could be. So as you get this exhaustion move down, this fast drop into 60s, that's your clue. That's the place to be getting out of your trade, and that gives you opportunity to exit. If you want to hold on further, you can do, and we'll see that from the price action from the ladder, where exactly you could have held on to this trade, and some of the clues that you should be looking for, and some of the things that you'd be putting into your debrief as to how exactly this traded to learn from in the future. What I've done here is, if you look at it purely from a chart point of view, there seems to be some very easy and very obvious trades to take here. We'll see on a ladder how particularly the fade at the top of that range was a very, very difficult trade to actually execute. So let's go and have a look at that, and we'll go and have a look at how this was actually traded. Okay guys, take note of where the pound first starts. The video will stop in a moment and you'll see the initial spike on the very first release, instant up towards 75, giving you very little chance of getting in. Now what you can see there, and as the box showed, it was instant to 75 and straight back to 40. This meant that the only way you could possibly fade this was by having an offer there. So your next area of fade is to establish where the market's ranging. We've seen a trade up towards 50 and we can't then get beyond there. What typically happens after the first spike is we get a bit of trade that creates a small range. There again, once up more, up towards 50s, and we find resistance. So this range is now being established. 131.20s up to 50s. Remember, 131.19 was the breakout point. That was your inside day break. So we're staying just inside there, holding above 20s, trading up to 50. So if you're looking to play the long trade here, the continuation to keep the move going towards new highs, you have that opportunity. You'll be playing this trade as long as we're staying above 20s. You're looking then for a break of 50s and a continuation higher. But what we start to see here, we're just over a minute after the event. Volumes have started to fade a little bit. We've started to slow down. Once again, another push up to 50. Do we see any continuation? No. So what we've now got is a range that we're waiting to see the break of. Now, from a technical point of view, those shorts could well now have been viewed as being squeezed out, and we're then going to get new shorts established on a break back below 19s and 10s. So that's going to be your idea. If you are sticking to this technical view that we have a position squeeze up based on the technical wedge break, that position squeeze up, then we're looking for more selling as we come back below 19s and 10s. Whilst above there though, whilst inside the inside days range, we've still got scope to the upside. And also based on the slightly more hawkish decision from the Bank of England, we've still got scope there. So there we go, down towards 20s, and we're starting now to actually just have a little bit of a tip through 19s, 20s. Find support again. You now need the support to act and start giving us buyers, bringing the market back up through the 25s where the average price is, back up towards the 50s once more. But what you now start to see here, it's struggled at 25. We've had another attempt at selling here. This could be your first attempt at the breakout trade to the downside through the 19s. If we can get through 10s, then you should get the acceleration. So here's the first push down towards 12s, 13s, and we find some buying quickly. Now the important thing here, if you're going for the short, is that we don't break 19s. If we get back above 19s, then your reason for the short is no longer valid. And also the more important element is you're looking for it to move back through 10s. We're not seeing that. We're now starting to tick back up above 19, and so we can now start looking for a move, particularly if we get through 25s, all the way back up towards the 30s to 50s area. So the first attempt is not there. That first attempt lower has failed at 19. We're now starting to tick back up through the range. And still a potential opportunity. Those who are long, they're still feeling they've got a little bit of comfort in this trade. They're still slightly safe on this, and we can still be looking for a further continuation up towards 50s and then potentially all the way up towards the new high. So we're back into that range and back consolidating once more. This is giving us a little clue. We're starting to establish a low that's important down at 12s, which also coincides with those previous lows where the main part of the breakout is likely to come from. So that's what we've managed to establish so far. Remember, these trades often can take a little bit of time before we get the next leg of the move, and so you get 45 minutes now before the next leg. The next video will show the final leg